Domino's got the orders, but lost something else. That is the strange part of this earnings report. Customer demand actually held up better than the headline numbers suggest. Orders increased across both delivery and carryout, yet the company still failed to generate the growth Wall Street expected. So what happened between the moment customers placed those orders and the revenue Domino's ultimately recorded? Management's comments provide an important clue. The problem wasn't simply weaker demand or a tougher consumer. Something inside the company's pricing, promotions, and product strategy didn't work as expected. And that creates a much more interesting question. Did Domino's have a temporary execution problem, or is the market beginning to see a deeper issue? And that question becomes clearer when we look at the numbers together. Domino's delivered growth in revenue and earnings, while order activity was actually stronger than the headline same-store sales number suggests. On the surface, that sounds like a reasonably solid performance. But the market was looking for more, because stronger order activity should normally translate into stronger sales growth. It didn't. That gap is the key to understanding the entire report. The issue wasn't simply whether customers were coming back or placing orders. The bigger question was how much revenue Domino's generated from each transaction. And that takes us directly to the most important weakness in the report, the ticket. And that brings us to the first real surprise. Beneath the weak-looking same-store sales number, Domino's actually saw meaningful order growth across both delivery and carryout. That matters because orders are the clearest signal of what customers are doing. They were still coming in, despite a challenging consumer environment. So the problem was not that Domino's suddenly lost traffic. In fact, the company was attracting enough transactions to make the result look much healthier underneath. But there was a disconnect between those additional orders and the dollars they generated. And that is where the story changes. If customers are ordering more, but sales are not accelerating with them, something is happening to the value of each transaction. That missing piece is the ticket. And this is where the gap between orders and sales becomes important. Domino's generated more transactions, but the value from those transactions was not strong enough to deliver the growth investors expected. Management pointed to weaker ticket, but this was not simply about customers spending less. Product mix and promotional activity also mattered. Domino's was lapping the strong impact of last year's stuffed crust launch, while newer offerings such as premium series and slice sauce did not generate the response management expected. Pricing was only modestly positive. So the issue was not demand itself. It was how effectively Domino's converted that demand into revenue. And that raises the next question: was this simply the consumer environment, or something Domino's could control? And this is where management's explanation becomes important. Domino's did not simply blame a weaker consumer or a difficult restaurant environment. Management indicated that the ticket shortfall was largely connected to factors within the company's control. That distinction matters because it changes how investors should interpret the weakness. If macro conditions were the main problem, Domino's would have limited ability to influence the outcome. But if product mix, promotions, and messaging were the issue, management could change the playbook. And that is exactly what the company is now doing. The message is clear: demand was still there, but Domino's did not monetize that demand as effectively as expected. So now we need to look at what specifically went wrong. And that brings us to the most specific explanation for the ticket weakness. Domino's was comparing against a period when the stuffed crust launch created a favorable mix and higher ticket. This time, the premium series and slice sauce did not generate the customer response management expected. So even though customers continued ordering, the mix of what they purchased was less favorable. That is an important distinction. Domino's did not suddenly lose demand, it lost some of the revenue benefit that stronger product mix had provided. Pricing was only modestly positive, which makes the product and promotional mix even more relevant. Management now has to prove that its next marketing moves can improve the mix without sacrificing order momentum. And this is where the ticket issue becomes more important. More orders are obviously positive, but they do not automatically create stronger economics when the mix of products and promotions is less favorable. That appears to be the tension Domino's is dealing with. The company kept customers ordering, but the revenue generated from those transactions did not improve enough. This is why simply looking at order growth can give the wrong impression. The demand signal is encouraging, but the monetization of that demand is what disappointed. The good news is that management has identified the problem and is already changing its approach. The next test is whether those changes can improve ticket without giving back the order momentum Domino's has created. And that brings us to Domino's response. Management is not treating the ticket weakness as something outside its control. The company has already adjusted its marketing approach, with greater emphasis on offers that it believes are clearer and more compelling to customers. The early response has given management some confidence, but the objective goes beyond generating more orders. Domino's needs to improve the value of each transaction while preserving the order momentum it has already created. That makes the marketing reset important because it directly addresses the weakness we just identified. But management is not relying on promotions alone. It is also preparing a new product that it believes could create a stronger customer response. That becomes the next test. And this is where Domino's is placing another important bet. Management has described the testing results for its upcoming product in unusually positive terms, suggesting it believes the product addresses a consumer need that was not being met. But investors should separate that confidence from actual market validation. A strong test result does not guarantee a successful launch. The real test will be whether customers respond at scale, whether the product improves the mix, and whether it can support a healthier ticket. In other words, this product needs to do more than create excitement. It needs to help solve the exact weakness revealed by the earnings report. And if that happens, the impact could extend beyond Domino's sales numbers to the economics of its stores. And that brings us to the risk beyond the immediate sales number. A weaker ticket does not automatically mean franchisee economics are deteriorating, but if the weakness persists, the pressure could eventually reach store-level profitability. Franchisees can benefit from more orders, but those orders still need to generate attractive economics after promotions, product mix, and operating costs. That is why management has to solve the ticket issue rather than simply celebrate order growth. It also explains why investors should watch the pace of new store development going forward. For now, this is a potential consequence, not the primary explanation for the results. The immediate question remains whether Domino's can improve transaction economics. And management's decision to maintain its broader outlook gives us an important clue about how it views that challenge. And that brings us to one of the most revealing signals in the report. Despite the weaker ticket and the softer sales outcome, management did not reduce its broader outlook. That suggests the company does not view the recent weakness as a fundamental break in demand. Instead, management appears confident that the issues around product mix, promotions, and messaging can be corrected. But maintaining guidance also creates a new test for management. The company now has to demonstrate that the changes it is making can translate into stronger ticket and sales productivity. So the market is unlikely to judge this report only by what happened. Investors will increasingly judge Domino's by whether management's confidence proves justified. And that brings us to the numbers Wall Street will watch next. And that is the key question investors are left with after this report. Wall Street will want to see whether the gap between order growth and sales growth begins to close. If orders remain healthy and ticket improves, the recent weakness could look like a temporary execution issue. But if orders continue growing while ticket remains under pressure, investors may start questioning the quality of that growth. That is why the next signals are more important than the headline EPS number. Watch order growth, ticket, product mix, promotional response, and the performance of the new product. Together, they will show whether Domino's has actually fixed the problem or simply managed around it. And once we put those signals together, the real takeaway becomes much clearer. So where does that leave Domino's? The most important takeaway is that this was not simply a story about customers walking away. Order growth tells us that demand was still there. The weakness came from how effectively that demand was monetized. Product mix, promotions, and ticket did not perform as management expected, while pricing provided only limited help. The company now has to prove that its marketing reset and upcoming product can improve the value of each transaction without sacrificing order momentum. If that happens, this weakness could prove temporary. But if ticket remains under pressure, investors may begin questioning whether stronger orders are creating enough economic value. Domino's got the orders. Now the market wants to see whether it can turn those orders into stronger dollars. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.